In the late 1950s, a professional dancer traveling between nightclubs, hotels, and theaters quietly made over $2 million in the stock market. He had no formal education in finance, no access to Wall Street, no real-time data. He operated from hotel rooms, sending orders by telegram, often days behind the market, and yet he succeeded where most professionals failed. This is not a story about luck. This is the real story of Nicolas Darvas and how isolation, discipline, and brutal trial and error created one of the most misunderstood trading strategies ever. Nicolas Darvas was not American by origin. He was born in Hungary in 1920. His life was shaped early by instability and war. After World War II, like many Europeans, he rebuilt his life from scratch. He eventually became part of a successful dance duo with his sister, Nicolas Darvas. Their performances took them across Europe, Asia, and North America. This matters because Darvas didn't live in New York. He didn't sit in brokerage offices. He didn't have access to insider conversations. He was physically disconnected from the financial world, and that isolation would become his greatest advantage. Darvas entered the stock market almost by accident. While performing in Canada, he was offered shares of a company, Brilland Mines, as payment instead of cash. He accepted without much thought. Soon after, the stock price increased significantly. He made money, and like many first-time investors, he misunderstood why. He believed he had insight, he had instinct. He understood the market, but he didn't. What followed was predictable. He began speculating based on tips and rumors. He subscribed to newsletters, listened to brokers, followed hot picks, and he started losing money consistently. Darvas realized something most people never fully accept. The people giving advice often didn't know more than he did. In fact, many were wrong, frequently. He documented this carefully. He noticed contradictions. Analysts recommending stocks already declining, brokers pushing ideas without clear reasoning, inside tips that led to losses. This wasn't just frustration, it was a turning point. Darvas stopped trusting news, opinions, market narratives, and decided to rely on something objective, something measurable. Darvas began studying only one thing, price movement. Later, he added volume. But initially, price was everything, because price couldn't lie. He started reviewing stock charts and price lists while traveling, and then he noticed something. Certain stocks didn't move randomly. They behaved in structured patterns. They would rise to a level, stop, trade sideways, then break out. This wasn't theory. He observed it repeatedly, across different companies, across different sectors. Darvas didn't invent his method from books. He built it from repetition. He defined what he saw as boxes. A stock would 1. Reach a high, 2. Fail to exceed it, 3. Form a clear resistance level, 4. Trade within a defined range. When the stock finally broke above that range, it often continued rising, not always, but often enough. So he created strict rules. Buy only when price breaks above the box. Set a stop loss below the box. Ignore everything else. No earnings predictions, no economic forecasts, only structure. Here's what makes Darvas unique. He traded with delayed information. He relied on newspapers, weekly price reports, telegrams. Sometimes by the time he acted, the price had already moved. So he adapted. He avoided volatile, unpredictable stocks, focused on strong, trending ones. He also introduced a critical filter. He only traded stocks making new highs. This contradicted conventional wisdom at the time. Most investors looked for cheap stocks. Darvas looked for strength. At one point, Darvas began seeing real success. His account started growing, then accelerating. But the real test came when the market turned volatile. Prices moved sharply, breakouts failed, false signals appeared. This is where most traders collapse. But Darvas didn't. Why? Because he wasn't predicting, he was reacting. When trades failed, he exited immediately. When trends held, he stayed. This moment, when his system faced instability, was the true validation of his method. Not the profits, but survival. Darvas didn't see himself as a genius. He saw himself as someone who made fewer mistakes over time. He wrote everything down, analyzed his failures, removed variables, until only one thing remained: a repeatable process. His success wasn't prediction. It was risk control, rule adherence, emotional detachment. Darvas later documented his journey in the book, How I Made $2,000 in the Stock Market. But most people misunderstand it. They focus on the method, not the mindset. Because the truth is, the strategy is simple, the execution is not. And that's why most fail. Not because they don't know what to do, but because they don't do it consistently. If you had a system that worked, but required you to ignore opinions, accept losses quickly, trust rules over instincts, would you follow it? Or would you do what most people do and abandon it at the worst possible moment?